As market volatility continues this year, we've been starting to see some companies report lower than expected earnings. The tech industry in particular has been hit especially hard, with an estimated 15,000 workers losing their job throughout the industry in just the month of May. With rising gas prices and supply chain issues, many companies appear to be heading into harder times as we progress throughout the year. This has also impacted dividends, with more companies reducing their dividends in 2022 according to Standard & Poor's. In today's video, we're going to be taking a look at stocks that currently yield 8% or more and have actually been able to increase their dividends this year. While there's no guarantee that these stocks will be able to continue to grow or even maintain their dividends, I think the fact that they've been able to increase their dividends throughout the first half of the year is really impressive. It might even show that some of these companies may be better than some of their peers if things keep getting worse in the economy. So with that being said, let's go ahead and get started. The first stock we're going to take a look at today is Kimbell Royalty Partners, ticker symbol KRP. Together with its subsidiaries, Kimbell Royalty acquires and owns mineral and royalty interests in oil and natural gas properties in the United States. As of December 31st, 2021, it owned mineral and royalty interests in approximately 11.4 million gross acres and overriding royalty interests in approximately 4.7 million gross acres. Their mineral and royalty interests are located in 28 states and include ownership in approximately 122,000 gross wells, with a lot of their wells being located in the Permian Basin. If we look at their dividend history over the last year, we can see that this company's been able to increase their dividend nearly every single quarter since January of 2021. Their last dividend, which was paid for 48 cents per share, was the highest they paid in this company's history. In terms of share price performance, their stock is currently up more than 28% for the year, now trading at $19.16 per share. This gives the company a dividend yield of 9.34% according to Google. In their latest investor presentation, you can see Kimbell has mineral and royalty assets scattered all across the United States. They estimate having over 15 years of drilling inventory remaining, which is something that's important to keep in mind. But they do offer an exceptionally high dividend yield to shareholders, and it isn't a master limited partnership, which means they don't issue shareholders a K-1 tax form according to their website. Pretty much the entire energy sector has been performing exceptionally well this year, and as a result, many oil and natural gas company stocks have seen their share prices explode. This is due to just how much energy prices have exploded this year, given everything going on in Ukraine, along with supply chain issues and many other factors involved. 2022 has been a particularly good year for both royalty trusts and master limited partnerships. Royalty trusts are companies like San Juan Basin Royalty Trust, ticker symbol SJT, and Sabine Royalty Trust, ticker symbol SBR, who hold royalty interests in oil and gas properties. Then you've also got MLPs like Western Midstream Partners and Plains All-American Pipeline, all of whom have increased their dividends this year. What's important to keep in mind with all these kinds of energy stocks, and especially more so with royalty trusts, is that the amount that they pay in dividends largely depends on oil prices. If we look at one royalty trust in particular, we can see that for 2022, the amount they paid in dividends has exploded given just how high oil prices have soared. San Juan Basin Royalty Trust's 3-year dividend history shows that back in 2019 and 2020, there were months where they didn't pay any dividends at all. And now that they've all of a sudden started paying really nice monthly dividends, this again all has to do with oil prices. With that being said, if you do decide to invest in oil stocks like these, keep in mind that they're very cyclical. As soon as oil prices fall, the share price of these oil stocks are going to fall and their dividends will probably be cut pretty significantly. Also keep in mind that master limited partnership stocks do send their investors a K-1 tax form. These are really unique tax forms that you don't get when you invest in other types of companies. You're required to file these with your tax return, and they're honestly a burden to have to deal with. If you have an accountant who files your taxes for you, then it's obviously no big problem, but if you like filing your taxes yourself, then you have to know what you're doing with these. But again, Kimbell Royalty doesn't issue a K-1, which makes this stock a really good opportunity for people who want to profit from surging energy prices. For me personally, I don't really like these types of energy stocks. Companies like Chevron and Exxon are exceptions, but I prefer to buy and hold companies for years. I'm not interested in having to monitor oil prices and deciding when I have to sell all of my shares before my capital gains are wiped off. But I've been seeing a lot of people flood into these oil stocks and enjoying the rising share prices. If you decide to do that, remember you need to keep your eye on energy prices to see when they start falling. Although based on what I've been hearing, it doesn't sound like that's going to happen anytime soon. Next up, we have Oaktree Specialty Lending Corporation, ticker symbol OCSL. This is a business development company specializing in investments in middle market, bridge financing, as well as first and second lien debt financing. Oaktree seeks to invest in educational services, business services, retail, healthcare, and manufacturing sectors, among many others. They seek to invest between $5 million to $75 million into each business, and they typically like to invest in companies located in North America. You can see this company's stock had a long history of falling up until 2019. That was when Brookfield acquired 61.2% of the company. Since then, this stock's performance has been really making an impressive comeback. OCSL currently trades for $7.02 per share, making it pretty attractive for anyone looking for an inexpensive, high-yielding dividend stock. According to Google, their stock currently offers investors a 9.4% dividend yield, and they issue dividends on a quarterly basis. What I think is also really impressive is just the amount of growth this company has been able to make. Most business development companies don't experience a lot of consistent growth, but Oaktree has been able to increase their dividend every single quarter since September of 2020. Of course, there's no telling how long they'll be able to keep this dividend growth up, and they have had to cut their dividend a few times in the past, but what we've seen so far I think really attests to the management team's efficiency. Oaktree is a specialty finance company that's dedicated to providing customized one-stop credit solutions to companies with limited access to public or syndicated capital markets. According to their website, they have a $2.6 billion investment portfolio, which is currently making them one of the larger business development companies in the sector. They currently invest in 140 companies and have a weighted average yield on debt of 8.7%. 70% of their portfolio is made up of first lien debt, which is something that I always like to see, and their portfolio is comprised of a lot of software and medical companies. According to their latest investor presentation, this company's continued to grow over the years, with Oaktree having 1,000 employees in 19 different offices around the world. They've been around since 1995, and they now have over $166 billion worth of assets under management as they've expanded their operations. Their NAV has also been trending upward and fully recovered from the pandemic. This has obviously been contributing to the consistent growth in their dividend distributions, which will hopefully continue going forward. Up next, we're going to look at a stock that's continued to experience some huge amount of growth in both its share price and their dividend distributions to shareholders, and that would be Arbor Realty Trust, ticker symbol ABR. This is a company that invests in a diversified portfolio of structured finance assets in the multifamily, single-family rental, and commercial real estate markets in the United States. They're classified as a mortgage REIT, and they operate in two different segments, which are structured business and agency business. Arbor invests in junior participating interest in first mortgages and preferred and direct equity. Their stock trades for $16.62 per share, and they offer a dividend yield of 9.15% according to Google. Their share price has fallen about 10% for the year, which is the most out of any stock on this list. Much like Oaktree Specialty Lending Corporation, Arbor Realty has also been able to grow their dividend distributions every single quarter for a number of years now. Their last dividend was for 38 cents per share, and they pay dividends to shareholders on a quarterly basis. Arbor Realty Trust is structured as a mortgage REIT, which is a company that provides financing for income-producing real estate by purchasing or originating mortgages, and some MREITs also purchase mortgage-backed securities. But Arbor Realty is pretty unique in their own way and within the MREIT sector. According to their 2021 annual report, 96% of their mortgage portfolio is made up of bridge loans. These are a very short-term type of loan that companies will use when searching for longer-term financing options. A bridge loan can be as long as a year under normal circumstances to as short as 30 days. These types of loans are generally safer than other types of mortgages because the companies seeking bridge loans borrow for a shorter period of time, and the whole reason they're looking for financing is because they're seeking longer-term options for a project they're pretty confident in. Their fourth quarter 2021 fact sheet shows that 91% of their portfolio consists of multifamily loans. In other words, a large portion of Arbor's loan portfolio consists of companies wanting to purchase or upgrade multifamily or apartment properties. And as I'm sure a lot of us are aware, given the housing market right now, this has been a very profitable business. As long as the multifamily sector remains red hot, I don't see this company slowing down anytime soon. We'll have to wait and see how rising interest rates are going to affect this company's performance in the upcoming quarters, but this stock continues to deliver very strong results to shareholders. Finally, the last stock on this list is Barings BDC, which is ticker symbol BBDC. This is a publicly traded, externally managed investment company that's elected to be treated as a business development company under the Investment Company Act of 1940. They seek to invest primarily in senior secured loans, first lien debt, unitranche, second lien debt, and subordinated debt. Barings BDC invests in manufacturing and distribution, business services and technology, transportation and logistics, consumer products, and service sectors. As you can see, this stock's had quite the roller coaster ride since their inception. Currently trading for $10.45 per share, BBDC currently offers a dividend yield of 9.19% to shareholders. For the year 2022, their stock is down about 5%, but if we look at their dividend distribution history, we can see that they've been able to increase their dividend every quarter since November of 2020, which is very similar to Oaktree Specialty Lending Corporation and Arbor Realty. Their last dividend was for 24 cents per share, which was an increase of 1 cent from their previous dividend distribution. I've only talked about this company once on my channel, and depending on where you're from, you might have heard the name Barings before. Barings LLC, the company that owns Barings BDC, is basically the result of what happened to Barings Bank, which was a large British merchant bank founded in 1762. In 1995, the entire bank collapsed, largely because of one man, Nick Leeson, who made fraudulent investments in futures contracts and pretty much single-handedly brought down one of the oldest banks in the world. Today, Barings LLC is owned by Mass Mutual Finance Group, and they're headquartered in Charlotte, North Carolina. But now they have a business development company which was launched back in 2006. Looking at some of their recent financial highlights, we can see some really good things about this company. Their investment portfolio continues to grow in a positive direction, as well as their net asset value. Despite continuing to grow, this stock is currently trading at a slight discount to their book value. Again, as you can see, their dividend per share has been growing every quarter for a couple years now, which is really good. First lien debt makes up 64.7% of their investments, which is lower than average, I'd say. I know companies like Ares Capital and Owl Rock usually have around 90% first lien debt, but much like their portfolio, their diversification I think is just alright. They don't appear to be invested in a lot of sectors I like to avoid, like hotels, restaurants, and entertainment venues, which are sectors that I typically like to avoid, and I think they're going to struggle a lot this year. Overall, I think Barings BDC is a pretty average company in this sector. It's not great, but it's been doing a lot better as of late, which is really good. And that's going to conclude our look at some stocks that have been able to increase their dividends this year despite everything going on in the economy. Again, there's no guarantee that these companies will be able to continue to grow their dividends or maintain them, but we can only hope that they will. Be sure to diversify your investment portfolio across different sectors and investment types, and always perform your own research and due diligence so that you know what exactly you're investing in. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.